There's a lot of that goes into really maximize the value of someone's company beyond just, throwing out a number.
We get asked this question all the time, right? Where are multiples at today? And groups out there, we're not doing a good enough job telling them what drives a multiple. We could tell you we're 10 to 11x, but does that really matter?
We get a lot of sellers that will come to us and say, we've got this thing that we can add back, and we're gonna say it's really not market, we can't, but we're gonna show them what good looks like, how we can get their company looking good and presenting it the best way possible.
The reality is no business is valued the same way. There are really two key inputs that drive a multiple, right? It's all about risk, it's all about growth. All right, how's everybody doing? My name is Chris Jenks. I'm CEO and partner of Amplify Capital Group, and with me, I'm Jeff Pavone, founding partner of Amplify Capital Group. Needless to say, it's been a pretty dynamic start to 2026 here. And Jeff, want to start off a little bit. We have a full quarter underneath our belt here. What have we seen so far to start off the year? And then more importantly, what do we expect to see here going forward for the rest of the year as it relates to car wash M&A?
Yeah, Chris, we've seen a kind of a very disciplined start of the year. So I think sometime around the fourth quarter, we had a podcast and talked about $1 billion in transactions getting closed over a 6-month period. I think it's going to get extended maybe a little bit, maybe it's 7 or 8 months, but we're going to see that about $1 billion in transactions that actually gotten closed. So there are deals that are getting done in the space. We can only tell you, and currently there are some significant deals in the works right now moving forward that should get closed by the end of 2026. What we're seeing right now is, though, an incredibly disciplined buyer. I think the buyer today has way more options than they used to. There's no deal they have to do. They're going to be selective. They're going to be disciplined in how they approach it, looking to densify some of the markets they're currently in, maybe get rid of some of the markets that they're not in. And there's a big emphasis now on new markets that are higher barrier to entry markets. We could talk about the Northeast and some other markets that have gotten some real strong interest, because we're finding out that, in some of the really more saturated markets or overbuilt markets, they've got a consistent problem. It's easy to build. And so, I think we're finding that some of the sponsors out there are looking at these other markets saying, they may take longer to build, but they're worth it because we're not competing with 10 other car washes.
Yeah, I agree. I think, if we're to take a step back here and think a little bit more about the secular drivers that really kind of create a lot of this enthusiasm around the car wash sector, a lot of that still remains today, right? We still have a high degree of fragmentation within the car wash industry, despite some consolidation amongst some of the top players in the sector. You have a consumer that continues to embrace professional car washing as a service. And then in a backdrop where you have the emergence of recurring revenues from unlimited member subscriptions, all that is very fair. You have exceptional unit level economics, the ability to scale the operation. What's different, I think, today is last year, to no surprise, we did have a little bit of stress as the sector as a whole digested a lot of the new unit growth, right? 2024, 2025, we continue to see a pretty healthy clip of new unit expansion. And as the market is fully digested, a lot of the new units that have come online, I definitely think we're back and seeing some really attractive and some interesting deals come to market today. But to Jeff, your point, it's a lot more disciplined. Now you layer on a macro environment where you have just nothing but geopolitical risk, whether it be conflict in Iran, uncertainty around inflation, Fed rate path, et cetera. So I think what you're seeing today is a lot more discipline in how groups are underwriting. And it's not to say they're avoiding M&A or they're not participating in full or paying nice multiples on deals and transactions, but they're a lot more selective in how they get there. And I think one comment you made is MSA. Your market certainly matters, right? We saw in certain areas of the U.S., fair amounts of encroachment just because it's easier to build a car wash. You don't have as much entitlement risk in the process, less development risk, easier to put the units online. That said, in other geographies of the country where you may be a little bit more landlocked, you have more abundant white space, there's more growth. And you highlight the Northeast specifically. I definitely think that's one core area in geography where we're seeing some activity today of some new entrants moving into the market. Any other geographies that you're seeing that are of high interest among some of the consolidators of car wash assets?
Yeah, I mean, the West Coast, I think, has some strong interest. I mean, we're finding that, you know, I think they've expanded. I think in general, they're expanding, looking at markets that have real opportunity for, you know, for growth. And so, you know, some of the Midwest markets or some of the markets that have been, I guess, underbuilt compared to some of the other markets where you got high density and it's all about give me high density and lack of competition makes for a very attractive place to go build. And so they'd rather spend, you know, if they got to spend an extra 25% to enter those markets, far more attractive than having a market where somebody can build 3 or 4 car washes in a smaller market.
So with that, let's talk about multiples where they're at. I think we get asked this question all the time, right? Where are multiples at today? And, you know, sure, we could fling numbers at you all day long, but I think groups out there, we're not doing a good enough job telling what drives a multiple, right? You know, we could tell you we're 10 to 11x, but does that really matter? The reality is no business is valued the same way. And as I think about multiples, right, going back to my old career, there are really 2 key inputs that drive a multiple, right? It's all about risk. It's all about growth. If you're lower risk, have high growth, generally speaking, you have a nice multiple, right? You command a premium. Conversely, higher risk business with not as much growth profile, you're going to trade below market. Specifically, as we tie that back to the car wash industry today, I mean, what are some of the common profiles that you're seeing in deals that we're taking out to market for those that are commanding, you know, above market premiums compared to some other deals that are transacting?
This is one of my favorite questions to get asked because it becomes where you have a lot of noise out there. You'll have a lot of other groups out there just throwing a number, a multiple number, 11 times, 12 times, 10 and a half times, you know, out there. And at the end of the day, that number is there's so much more that goes behind that number. And so when we look at it, when we publish reports, and let's say we've averaged at Amplify, you know, 12 times, you know, over the last year on a multiple, that information could be used in the wrong way. That doesn't mean everybody gets 12 times. And let's use a case study of a deal we just closed. That was a significant deal, north of $100 million deal. You know, and the multiple was in the low double digits. You know, that's great. But the fact of the matter is, you know, they had a brand new build, you know, that was almost $8 million. That was new, open 6 months. That's included in it. And they had pricing from retail to membership that was below market with really some of the best assets in that market. And so the ability to get that down to a 10 or a low single digit within 12 months was really high. So when we talk about multiples, there's a lot that's going to go into it. You know, what was your build cost? You know, some guys are building these things for, call it 4 million, and some guys are building for 8 or 10 million. You might not get the same multiple, right? Because the guys building in the lower price ones are typically buying in real estate in markets that anybody can build in. And so I think you got to look at the kind of market, the kind of build. Then you look at CapEx. You know, when you're looking at coming into a site, you know, was it newly built? Are you using, you know, who's your POS provider? You know, what does your equipment look like? I mean, so when we start looking at this, we're going to help you really break down what good looks like from all the way from operations and KPIs to what your construction and build looks like. And so there's a 100 things that's going to go into us being able to answer that question of what a multiple is going to trade at.
Yeah, to me, I think about, you know, to your point, we can show where the market's at. And you can't control where the market's at, but what you can control is how you position your business for a premium multiple. There's a lot of prep work and understanding what metrics the buyer pool really looks at and they hone in on as they're underwriting deals. And more importantly, as they're thinking about how much your business and your chain is worth. You know, to me, I think the most important thing is centered around the unlimited subscription model, right? Recurring revenues, that's a large reason as to why, you know, the sponsors have aggressively pursued this industry and this sector is because of, you know, exceptional unit level economics, you know, $2 million in top line supported though by a subscription base behind it. And generally speaking, I think one of the the key metrics a lot of groups would focus on would be membership penetration rates. So that's one key thing to think about as you're entertaining selling your business. Membership penetration just essentially measures how much of your revenue is derived from your subscription base. What good looks like in our business, you want to be kind of around that 75% mark, and that shows a nice, healthy mix of both retail and subscription base. But you have that sustainability, the repeatability of that recurring revenue at the membership penetration at 75% range. That's one key thing is focusing on how to position that subscription business, because again, that's the lifeblood of what groups are looking at today.
Yeah, no, what I was going to say is, one of our role that we play at Amplify with our client is we really need to do a few things. One is make sure the expectation is set properly for the owner or the seller. And I could tell you, we're not sitting here ever promising a certain multiple. What we're going to do is give them an expectation based on where their car wash chain is at, and two, where the market is at. And because of the amount of transactions that we're involved in, we're not basing this on fiction. We're not basing it on anything but having real deals closed and having other deals out to market and knowing what those bids are coming in at. So from a market standpoint, we got to really make sure we're advising our client on what real is in an expectation. Two, what we try to do is we really got to dig in deep in looking at their company and saying, okay, take their KPIs. And again, one of the easiest KPIs, we can look at chemicals. And in chemicals, if somebody's spending 65 cents and market is 40 cents, we can look at that KPI and say we can make an adjustment on that, on chemicals of 25 cents. Well, in one particular case, we've got a client washing 5 million cars. It turned out to be $1,250,000 bottom line times a double-digit multiple. It was a material lift in valuation. And so what we're going to do is we're going to sit down with a client and review all of their KPIs, from labor hours to chemical costs, to saying, okay, how do we prepare your company to look good? To what add backs will a buyer look at and say are reasonable? Because we've got a lot of sellers that will come to us and say, we've got this thing that we can add back, and we're gonna say it's really not market, we can't, but we're gonna show them really what good looks like, how we can get their company looking good and presenting it the best way possible. But I would say there's a lot that goes into really maximize the value of someone's company beyond just throwing out a number.
Oh, agreed. I think that's where, if we look at this space and some of the largest deals that have been transacted here, I think that's where we see a lot of processes that have failed with the bulge and bracket iBanks out there. And by no means is meant to be disrespect or derogatory, but this is a highly specialized industry, right? Car washing is a unique beast. And there aren't a lot of groups that understand car washing, right? I think the one interesting thing, Jeff, is we've seen the evolution of this space for, north of 20 years, right? I mean, you've been central to a lot of the kind of key consolidation with the likes of Commercial Plus. We know this space well, and I think that's the key differentiator here, right? Is how specialized it is, being able to talk the talk, know the playbook. We've had the opportunity to see some of the most successful chains on the market today and see what really drives value. And I think understanding kind of how to reflect, understand the business, do that forensic work to understand where there may be opportunities, whether it be through add backs or adjusting the P&L, but also just giving the operational playbook where, it may make sense to not transact today. It may make sense to spend the next 6 months and beyond to write your business, get it to a position where you command that premium multiple in the market today and have a successful outcome. And I think that's a key difference, right? If you think about, you have the bulge and brackets on one end, and they kind of lack that sector specialization, really effectively position a chain. On the other end, there are a plethora of brokers out there. And I think that's the one thing that's different with our process, is that it is in fact a process, right? We're not just matchmaking and walking away. What we're doing is we're spending the time as your advisors to walk through, again, how to position your business, how do you command best multiple possible based on the characteristics and attributes of your company. And we walk you through from start to finish to find the best outcome. It may not always be selling in full, right? It might be finding that right capital partner. It might be reviewing the debt stack in your cap table and reforming your debt for growth into the future and alleviate yourself from personal guarantees. But the point here is that it's a kind of intersection of the sophistication, the industry specialization that somebody really needs to get to the outcome that they deserve.
The biggest challenges for us to help navigate is this space is dynamic. I can tell you when somebody asks me where we're going by the end of the year, we're almost month to month, quarter by quarter, because here's what we can't answer. Right now everything could be going great, and the question is, what's that boogeyman in the room? And we just don't know because they keep coming up. So in this case, over the last, we really expected to see some really great volume getting done here, and all of a sudden the private credit markets, start getting squeezed, and you start seeing you see all this private credit is kind of the blood that feeds private equity. And so, why is that important to you? Is because if private equity has cap limitations or limitations on that private credit, they've got to readjust on their thinking and how they move forward on taking down deals. That's a problem. I mean, that becomes a real problem with some of these guys getting deals closed. So, we're constantly looking at who the buyer pool is, and I would tell you in real live term every day, some groups that could have been buyers, 2 months ago, today could be guys that just absolutely can't get a deal done. And so we've got to navigate sort of understanding who today in real time is qualified to close on that transaction. And we're seeing the good news is there's some new entries. There could be some family offices. We've got, our deals that we're dealing with a much more diverse sort of buyer pool. But some of the guys that have been there for a long time are probably not the guys that are going to get a deal done anymore.
Yep. So I want to rewind a little bit, though. You mentioned private credit, being a stress in the market here. And I think we talk about it, we know it, but maybe to take a step back here, I mean, as we think about the private credit market itself, it has become a very significant force within capital markets, right? So if we were to go back to, financial crisis, majority of loans and credit that were formed were traditional, bank loans. As a result of the financial crisis, we had a lot of regulation through the likes of Dodd-Frank, which restricted the bank's ability to get creative in how they think about underwriting loans. Therein lies the emergence of private credit. And, as we think about private credit today, it's morphed into about a $3.5 trillion pool of capital. And to Jeff's point, private credit's been a big funding source for private equity mergers and acquisitions activity, right? And on the other end, so you have private credit here, and we have had some hiccups in the earlier parts of 2026 here in Q1 with the likes of Blue Owl. There have been some questions around software exposure with the emergence of artificial intelligence and what that means for a lot of these private credit funds that have significant exposure to software. And I think we saw as more or less a rationalization of some concentration across some of these key flagship private credit funds. Now, we'll say, I don't think we view that as a systemic risk, right? We don't see this as something where the market's going to implode because of this, but this could restrict the ability of private equity sponsors to effectively deploy capital. To me, as I think about some of the issues that come ahead, no surprise, private equity has grown. I mean, markets for the last 20 years, we've seen this big shift from public markets to private markets, right? I don't remember off the top of my head, but I want to say public markets have shed approximately 2,000 companies over the last 7 years alone. We're seeing public markets shrink in size, but we're seeing this tremendous growth in private markets. In fact, private equity today, I want to say they hold about 16,000 portfolio companies. And to me, I think one challenge we're going to see here in the future is with limited M&A, specifically in the exit, we're going to see a number of private equity sponsors rationalize with how do I deploy new capital and invest in new businesses that are attractive and accretive to my portfolio of companies versus how do I exit, right? Today, that ratio of portfolio companies to exits is about 11-1. So what we need to see here is a clear path to exit. And this isn't specific to car washing. This is private equity as a whole. But I think as we tie this back to car washing, it's going to be a pretty interesting year ahead because we're seeing a number of sponsors here that are getting a little long in the tooth in their holding period, right? Private equity will typically hold, companies for about 5 to 7 years. And if we think about, certain names within our industry and certain sponsors that have backed some of these platforms, they're breaching that mark here. And I want to now tie this back to something that you just mentioned here, Jeff, which is family offices, right? I think as we think about attractive pools of capital go penetrate, family offices are a perfect match to the car wash sector, right? You need patient long-term capital because as we talked about in the past with Mr. Car Wash, right, a big reason why Mr. Car Wash was a misfit for public markets is that within public markets, you are in the pressure cooker of a quarterly earnings cycle, right? It's very, very hard to be long-term thinking when you're worried about the next readout in earnings and what ultimately how the sell side's going to respond to that. Conversely, though, family offices, they're perpetual investors, right? They're long-term thinkers. They're not bound by a quarterly earnings cycle, nor are they bound by a 5 to 7 year holding period in their fund. I think that's one interesting area. I mean, do you agree, Jeff? I mean, are we seeing a lot of interest today from family offices in this
Yeah,
sector?
we're for sure seeing more. We're getting in more inbound calls from family offices, and it's interesting. There's some negatives and positives going on in the industry. The positive is that car washing as a whole is a good business. It's proving to be quite stable. You're seeing growth. You're seeing membership stability. You're seeing, and then you've got a bonus depreciation on the equipment. I think you're seeing a lot of reasons why this is an attractive space for an investment. And to Chris's point, though, is the investment in it was built around, I call it private equity with short-term life cycles of getting in and getting out. And that's where the stress is coming in is some of these groups that started out early are long in their cycle and there's no clear path for an exit. That presents a problem for that buyer pool. That takes maybe a half or more of the groups out of the buyer pool that we're seeing. The positive side of it, because their car washes are performing on a long-term basis and the attractive tax benefit, we're seeing family offices and new buyers. We're even dealing with some, overseas, groups that are looking at this space and saying, we like the space. And so at the right entry point. So the good news is I think right now there's plenty of good opportunities in inventory at the right entry point. This is a very attractive for investors. But you've got to work a little bit harder at having a broader pool of who that buyer might be and how that deal gets structured.